Hey guys, in today's video, we're going to go over why candlestick strength and weakness doesn't matter, candlestick patterns, news, all that kind of stuff. So I've been trading for about 10 years now. The first 3 years was so bad for me because I was trading like everyone else is. I was learning the same exact material, just material that was never consistently profitable. I would have a couple wins and then I would lose, and it just wasn't consistent. And so that's how 90% of people feel because of the fact that there's so much outdated information online, and people really just truly do not have a good trading system. That's really what it comes down to. There's a lot of fake gurus. There's a lot of fake marketers that are honestly just using your money and trying to basically sell you this system that doesn't even work, that they don't even trade, or they don't even trade in general. So I'm going to kind of show you how why the candlesticks and news and stuff doesn't matter. So realistically, news and candlesticks are a distraction to what's really going on. Candlesticks are just great in regards to how they react on specific prices that you want to enter and exit off of. And the reason for that is because the banks, hedge funds, all that kind of stuff are adding millions of dollars at specific prices. And that's kind of what we want to aim our focus on. We don't want to aim our focus on, stupid stuff that doesn't matter in regards to patterns and all that kind of BS. So drawing, we're going to start drawing our major zone at the top of structure where it reacted. So if you look left, the key is honestly looking left no matter what. So when you're looking left, you can actually see prices react over and over and over again. And that's kind of how you can get your entry. That's one way. So if we just take the numbers here and attach them, we have two prices at each zone. So based off the left-hand side over here on November 7th, at New York session, basically this ended up breaking and testing this structure right here, and then it continued down. So based off this structure, we can see that, okay, if 669 and 838 is not breaking above, then we can set up for a sell. Because if you look left, we can see that it sold here and it sold here. It did go up here, obviously. It went higher to the highs at 500. But the point is that at this specific point, it ended up breaking, and so did it here. So when it comes up, first of all, if we jump down on a lower time frame, so if we go to 1 hour and we look left, this is a massive imbalance that needs to fill, essentially. So basically, when it comes to that major structure on the 4-hour time frame, and based off the left, we can see that it reacted and it dropped significantly. Obviously, that was over 1,000 pips. We can take the same sell setup in that regard at that same price. So between 8, 7, and 6, around 650, you could basically take a trade. So again, taking a trade on a lower time frame, basically what that looks like is when price is hitting. So we have our 4-hour zone, price is coming up. Let's just say you missed buys down here and price is coming up. What you want to do is monitor it on the 1 hour. Once it hits the 1 hour, wait for the one reaction to hit, wait for it to manipulate. And then basically as it's hitting in those prices, you can drop down and you can get anywhere in between here. So if you got 838 and basically let's just say 738, you could have any of these prices to enter on, and the lower you go, the more price action you can see. So this is 1 reaction, 2 reaction. Here's the 3rd reaction. Technically, you could enter at 738. And then once you do take the entry again, and the major structures are the best entry, the major zones, because of the fact that it creates a lot of momentum and a lot of volatility, and that's what you want. Obviously, you want it to move. So once you take that entry at whatever price you're ready at, it depends on the time that you're awake, et cetera, et cetera. Once you take that entry and you put your stop loss above. So I usually do between sometimes 15 pips, 20 pips. The max I'll do is 30 pips for a stop loss. Why I personally teach in my group not to do a super small stop is because most of the time you'll get stopped out and then it will go in your direction and it gets really frustrating and annoying. The lower you go, you can have a tight stop, but like to avoid getting stopped out and then going in your direction, you want to give it a little bit of space. So in this case, if we entered at 738, let's just say, 15 pips is appropriate. We could even do it above this wick just in case, or we could do it above here. It's such a personal preference, guys, but I feel like the bigger, the better in the sense of getting wicked out and then getting stopped out and then you having to re-enter, because sometimes in a live example, you'll be like, oh shit, like maybe it's going to go up. Obviously it's not. And we have that confluence and that confirmation, but that's sometimes what you think. Your emotions are all over the place when that does happen and you get stopped out. So it's best to not get stopped out. And so I would do a 15 to 20 pip zone, essentially. Stop loss, I mean. So when you take the entry, a lot of people get so caught up in this and they'll stay on the lower time frames and they'll be doing their targets on the 5-minute time frame. And so this is like, I mean, GJ moves fast, right? So this is 61 pips. That's a 1 to 3. And then this is 129. It's a lot, right? But here's the thing. It's like, why don't you take advantage of it if it's moving? Like, why don't you just keep in it? So what you want to do is once you take the entry off a lower time frame, go back up to a higher time frame. Go to the 1 minute, and then we can identify where our zone is going to be. Okay, so based off the left, obviously this is a big imbalance and it will entirely fill. Like the whole thing will fill. It doesn't right away, obviously. And you'll know that from back testing and stuff like that, but this will eventually fill. It'll eventually come down to 195.8. So based off this, so if we look at the 1 hour and we're thinking, okay, well, where our zone's going to be, where is it reacting? We can take it from the left and we can draw zones of where the reactions are. So there's a couple in between here where price has reacted. You don't have to do a lot. You can just do a few, how many you're comfortable with. And then again, add 2 prices at the zone. Just doing that quickly for you guys. Okay, so add 2 prices at the zone, and then you'll kind of have an idea of where your target's going to be. So target 1 between 166 and 009, this would be your target 1. Just making sure, like not actually setting a TP, but making sure these 2 prices break, okay? Because of the reversals on the left-hand side. So this obviously broke. Okay, cool. It went to 392 and 365. This would be our next target. So depending on the sessions, obviously there's different sessions coming in. So basically, so it ends up coming in. So this is, what is this, midnight? Yeah, midnight. So this would be New York session. So London session is going to finish. New York is coming in. So this is New York at 5 a.m. We get a reversal. We end up staying below the structure and then continuing back down. So these 2 prices have to break in order for us to continue to take that target. If those 2 prices can't break, it's going to correct higher up. Now, here's the thing. People, have been taught, and it's not your guys' fault. It's like there's a lot of people that have been taught just BS, and I was taught that as well. See how it's not based off candlestick patterns or weakness or anything like that? You know, majority of people wouldn't even think about taking it at major structure. They would look for a strong candle and they would sell here. thinking, oh, okay, it's going to continue down, it's going to continue down, and it's going to fill here. Some people do know about imbalances. Everyone teaches it differently. I teach it completely differently, but that's what people would be looking at. They'd be like, oh, okay, like it's a strong candle, I'm going to sell here, but they're not even like focusing on what prices to enter at, what prices to exit. They're focusing on candlesticks, and that is why they are not consistently profitable and confused, honestly. So these two prices have to break below. Now, let's just say a news event happened. Okay, so what day is this? December 19th on Thursday. Okay, so let's say a news event is happening on Thursday with the yen, and the yen is going to weaken. Let's just say the interest rates are lowering. So interest rates usually increase the currency and make it strong. But let's just say for yen, the interest rates were lowering and the yen was decreasing in strength. Okay, so it was weakening. So let's just say that was happening. And so basically, people would take the news event and they'd be like, okay, I'm going to buy here. They're going to buy here. Okay, great. It ends up respecting and then it comes up. But realistically, we know from the 4-hour that this is a major structure based off the left-hand side, and we had a significant drop from there overall. Okay, so again, people are going to be looking at the news, they're going to be buying, and then it completely drops on them because they're so focused on that news event. Whereas technicals is showing you it's a sell based off the left-hand side, based off how it respected those prices. So news is coming in and it's creating momentum, but it's tricking you to think that it's going to be a buy, even though it's a clear sell with technicals. This is why fundamentals do not matter. I have not looked at a fundamental calendar in years, and it completely changed the game for me. It made me consistently profitable by just going off technicals. Now, you can look at the calendar and you can look at any news event that's happening, but again, it's just creating that momentum. That's what you want. And so two things that are a major flaws in this industry is not getting in during news and getting out before news happens and just being afraid of news. It's crazy to me because that's when you're missing the opportunities. And like I said, no matter what the news event is, it's usually priced in no matter what. So it's going to go no matter what. It does not matter. So that's the thing, is like you have to really focus on what matters and you have to get rid of the distractions. So those are the two things. Don't rely on candlestick patterns and news. Like don't let it affect your trading in the sense of you not entering or not getting out. So some people will be like, oh, okay, we'll enter after news. Okay, so these two prices has to break below in order for us to extend our target. So basically what ends up happening is it comes up, it fully retests the structure. Technically what you can do is take a sell here. But basically what would happen is people would be like, okay, well, just take the sell after news happens. Let's say this whole movement was news, okay? And then you get in after news. And our target's here, okay? At this imbalance. We get in after news. It is the stupidest thing ever because so our entry's up here. If we waited this whole time, we're missing out on almost 200 pips. That's crazy. That's insane. If people are telling you to wait like days or weeks or whatever to take a trade, they don't know how to trade. I'm telling you. But the point is to get in before that news happens and to get in on major structure or the break and test of structure. So here's another position right here. Okay. So again, you would make sure these two prices break. So this ended up breaking and testing. Technically, you could take another sell here. Make sure, guys, that you measure how much it's going to be each zone. Like if it's 58 pips, if it's, 81, but if it's like 20 to 30 pips between a zone and then it's about to reverse, it's not worth taking. So you have to be careful of how much you're adding in because eventually it's going to reverse. So if this 657 does not break below and this price, this 900 is breaks above, then it's going to come up and correct. So let's just see. Okay. So it couldn't break below. It ended up retesting and then coming back up to test in. Okay. So it tested in and ended up respecting. Again, to get more price action. So this is at the 200. So it closed at the 200 right at this break and test here. So to get more price action, you can go down lower and see how it gives you more price action. So this is the first reaction in. This is the second test in. It closes below the left-hand side. This is your entry. Okay. So we're still good. It ended up actually filling the entire imbalance. Sometimes what happens actually, I find, is that sometimes it'll fill like a half, basically come up to here, and then basically come up to the highs again. Sometimes that does happen, and then it comes down to fill. So in this case, actually, it ended up filling right away. So it filled these two prices. It tested into these two prices that I had in here. And so basically, these two prices have to break in order for it to continue down. But see how all the price action is hitting all the numbers that we have in? So this was 1, 2, 3 reactions. So you know what people call this in the market? They would call this technically like a triple bottom. It's so funny. I was taught this shit before. Realistically, what's happening is it's coming into this exact price 3 times. I call them reactions, and it's coming in at different times. They're adding more buy orders and like at a better price. Essentially, they're not going to buy it at 277 or 230. They're going to bring it down to a better price, and then it starts moving the market. And especially at specific time. So this is London and then New York. So this price, this 843 can't break below. So then basically it comes up, it tests into these two prices. So these two prices have to break in order for it to continue up. Okay, so what happens? It tests into our same price over here, 277. We get a break and test at this price at 590. And so these two prices have to stay above in order for it to continue up higher. So it comes down, tests into the same price, and then we start ranging for a bit. That's when it gets annoying. So basically it filled this imbalance right here, tested in, and now we're waiting for a break above. There we go. So it starts ranging. What I tell my group is when it's consolidating like that and ranging, just because it made a big movement, I tell them to wait. I tell them to set an alert. So I tell them to create an alert at a specific price, wait for it to break. So it tried to break above this next area, ended up closing, and now we're retesting. These two prices have to break in order for it to continue up. Okay, so we finally get that break up. So then it tests in, basically tries to break below, what was this? So you start to get minor zones in between as you keep going up. So this was close to 197 even. So it has 1, 2 reactions, and then it carries on, retest these two broken prices that needed to be broken, and then it continues, retest these two prices we originally took an entry at that break and test, and then goes back up to the high. So that high has to break in order for it to continue down. So it doesn't. So it taps in 1, 2, 3, and 4 times. And then it continues down. So some people enter on like the first or second reaction. If it keeps coming up to major structure, there is times where it will test in multiple times. They're just at different times and days, obviously. So they're adding a ton of money at these prices. So what you can do is if you sold, let's just say here at the same price, and again, these two prices have to break below in order for you to extend your target. And it doesn't, and it comes back up, and then you take it again, it comes back up. This is where you have to be super careful because of the fact that it will start to manipulate if it doesn't close below structure. So basically what you can do is, even if you didn't want to get it at major structure, you were unsure, wait for it to actually respect. And then if you drop down on a 15-minute or 5, basically what you can do is you can count down. So major structure, let's say it's at 669. Basically what you can do is get in at, let's say 569. You can get in at, let's say 500. And basically you'll look for a break and test so that you know it's confirmed that it's reversing off that major structure. You're just counting down to get in, and then basically you go on a higher time frame, and then your same targets are the exact same as they were here, the same numbers, and they'll react over and over again. So again, so like another thing, people would be like, oh, okay, I'm gonna enter at the strong bearish candle, and they'll enter here, they'll put their stop loss above, and this was a 35 pip wick. So they would get stopped out, and then they would be like, oh, okay, well, the left is showing, bullish from there, and then they'll enter a buy. And it's just like a mess. It's a friggin' disaster. I did it all when I first learned, and it was a nightmare. So you really have to focus on how the candles are reacting to price and what prices you're entering and exiting off of. And in regards to news, just honestly like it's just a part of the cycle. It shouldn't be there to distract you or to not get in or to get out. It creates momentum, and that's exactly what you need. And then another thing too is, some people will see the news event and freak out and think it's going to go the opposite way. Like, let's just say a news event is coming and people will be like, oh, okay, it's going to buy here, but the price action is obviously saying different. It's off of a major structure. We know it's going to be a big movement compared to the left and to the left here and so on. But the news, like, people freak out and think it's going to go the opposite way and spike and do all this stuff. No, it doesn't. Okay, so I hope this makes sense, guys. Let me know if you guys have any questions in this video. Please like and subscribe.